Còn những cái hồ sơ luôn. Ý tính tại sao này? Kèm đi nó không nói, kèm đi. Cái ngày ngồi em không kèm đi á, cho lại rồi ai. Nhà ai đó chơi hả? Nhà đi kèm. Nhà đi kèm. Yeah. Sai bung vào. Thì vậy đấy sẽ là cái bên đây có một anh có mấy trang rồi anh nó ký nó anh có lắm gì anh có phải còn gì ta ở đấy đố này đấy anh là gì có tưởng là đây có đây này chỉ này cái thằng là cái chân nó là của nó cái này cái thằng là con cái này phải có màu còn tay kia đây nó trở nó phải làm sao bây giờ anh có khổ này có phải cái hay khó phải anh cảm thấy ra như là được anh nói cho đã anh cho đã qua rồi có cái thì cái máy nó khổ bye bye. Thôi anh không chơi đủ qua không đi à mẹ ơi thì biết đấy biết nó hồ đi thì giờ nó đâu ta cảm biết là nó ổn là biết nó đâu một cái bên hai một cái à mơ mấy anh số cà phê anh nói số cà phê thì đến rồi à nó taxi còn gì mất trong thì cái này nó trâu rồi để tao biết không đó rồi mấy chơi đã sang thì mỗi mà nó biết có chơi chỗ cho ấy đây quả ai thầy bắt không dễ thôi có cái số không ba để lấy bắt tủ này tại bắt tủ anh chưa đặt những phải anh tính sáu này không phải là nói mình chọn cái cổ tổng từ ba đến ba cái số chỗ của ra cái môn tập đó là cô nhà tôi làm cái còn nó cái là của nó không có bao giờ
Okay. Hello. Yeah. So I think on Tuesday we're talking about time of supplies, time of supplies, and now we will start with tax rate and tax base. But before we start with tax rate and tax base, I want to maybe ask you a few questions, with respect to the time of supplies. So, what is the main rule for the time of supply? What is the main, the main rule for the time of supply, or the main condition to consider as a time of supply for VAT? Seven days. Okay. 7 day from when? From where? Hmm? Maybe not correct. Huh? Maybe you want to try? Repeat. What is the main condition or main rule to consider as a time of supply under the VAT? Yes, correct. When you issue invoice, that's the main rule. So it doesn't matter you do a supply or you receive a payments, as long as you issue invoice, then it is time when you actually make a payment. Yes, 7 days after goods deliver, 7 days after service performs, or 7 days after the payment received. It's a second condition to force a supplier to pay tax. Yeah, because they understand that many taxpayer doesn't want to pay tax, even though sometimes you actually receive the payment. You got money, but you have money, but you don't want to pay tax. That is a nature of taxpayers. Okay, and yeah, we also have other like condition for the time of supply with respect to law or maybe contracts. Then you have to follow the condition under the contracts when you need to issue invoice, or when you need to when that you can receive the payments. Okay, so yeah, we talk a bit about tax rate on Tuesday. So no, sorry, Friday last week. Yeah, Cambodia. In Cambodia, we have two VAT rates: 10% for import and domestic supply. So all import of goods, only import of goods, only import of goods, all import of goods are subject to 10% VAT, plus import of digital service, or we call e-commerce, kind of it, e-commerce. Or digital good. E-commerce service and digital goods are subject to 10% VAT. Yeah, we will talk about what is the e-commerce, what is the digital goods, later. But maybe at the end, at the end of the session, we will talk what is the e-commerce mean, what is digital good means. Yeah, this kind of rule we just implement back in April 2022. Yeah. So before, only import of goods that's subject to 10% VAT. Import of service is exempt from VAT. And domestic supply, which means you sell in Cambodia, you supply in Cambodia, you required to charge 10% VAT. That's a general rule. But for exports, yes, export of both good plus service are subject to 0% VAT. Yeah. But how to define export of goods? I think it's easy. You can prove it what we call custom declaration forms, but export of service kinds of difficult. We will talk about it. So what is the condition? What is the nature? What is the document you need to prove? Yeah. Okay. But just remember, export good and services 0%. So in Cambodia, we have two rates, 110, 10. Okay. Next, we talk about tax base or taxable value. Yeah. Taxable value or tax base. The terms, the term used is the same meanings. So, and we talk about import. The taxable value for imports, we call CIF plus custom duty plus excise tax, if any. What does CIF mean? CIF is cost plus insurance plus freight. Yeah, CIF. So cost of goods we purchase, cost is a cost of good we purchase. Yeah. Let's say we purchase cost is, 1,000. Insurance, normally when we want to transport good from overseas into Cambodia, we must pay insurance. Let's say insurance is another $100. And freight's probably maybe 500, maybe another 200. So then you need to add the three components together. So it's, plus is a CIF equal 1,300. Yeah. And then you use the CIF to calculate custom duty. If the good is subject to custom duty, and then you calculate custom duty. Or sometimes you call custom tax. Custom duty equal CIF multiplied by rate. Rate can be varied. It depends on goods. We have more than 7,000 goods. Classified. Different of around more than 7,000 different goods. That is in international classifications under custom law. So the rate can be 0, 5, 7, 10. You multiply by, and then you get custom. Okay, let's say XX. Okay, and then you calculate excise tax by adding CIF plus custom and calculate. We call excise tax. Excise tax is a kind of tax on consumptions. They collect on certain goods. Mostly they focus on luxury goods and health harmful products, such as health harmful, maybe alcohol, cigarettes, and all kinds of luxury goods. Luxury car, luxury other luxury items. Yeah. So all of those, the custom will impose, we call excise tax on top of customs tax. After that, we get, CIF, we get custom duty, we have excise tax amount, we add all the component together. This is a VAT base, so it's a kind of like tax on tax. We collect tax on VAT on top of all kinds of tax. We have to include everything. So for custom, this is the way that how we calculate, the VAT. For supply of good or service, the price of good or service that the supplier charge to the customer. Look at this. This is a main rule with respect to supply of good or service within the country. They say the price of goods or services that the supplier charge to the customer. The price of good or services that supplier charge to the customers, which means what is the supplier get from selling of good and service, that is the taxable value under the local supply transaction. Yeah, but actually we learned about taxable supply previously. We're talking about the appropriation of good, supply as a gift, supply below cost. Yeah, so that's the three condition is a special one, because they expect to collect VAT from the supply of good and service. They do not expect that you pay no tax when you do a supply. That's why they classify the three special conditions under the supply conditions. Yeah. So, but the value you can use to pay VAT, that it depends on the condition of each transactions. Yeah. Okay. So, but now you know what does the value mean. In general, they said taxable value for supply of goods and service is the charge, that the supplier charge to the customers. Whatever the customer pay to you, to the suppliers, this is a taxable supply. Okay, that's the main condition. Okay, but they said, as I said earlier, making a gift or sell below price is a fair market value. Okay, that's fall under special conditions. You supply under the gift, somebody as a gift, or below price. Yeah, below price we discuss about it. Sometimes we do a discounts, but if you do discounts, that's different condition, right? Apply. But if you provide a discount only for the specific group of people, such as your employee, maybe your relative, or your related party, under the VAT, the tax law say that is not a proper transaction, then we use a special rule, which means we don't, we don't believe that what the value that you for your supply is the market value. Then you need to use a market value under that special condition. Yeah. Okay. Yeah. Fair market value. What is a fair market value? Or simply say a market values. Can anyone tell me what is the market value means? Value that we can buy in the markets. Generally agree with one. Okay. More? Yeah. You agree or you charge or you, yeah. Yeah, I think you're correct. That's part of it. Maybe you ate a little bit, I think. Yeah. The value you agree, or you value that the supply and the buy, the sellers, the value that seller and buyer agree on that conditions at the times, and the two party is not related party. Okay. Yeah. Just we ate the not related parties. If you are related party, they don't trust you. Okay. Yeah, related person, you already learned, right? You know, direct group, well, director, you have purchased more than 30%, blah, 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 a few other points. So if you want to justify the fair value, you should use the value that you actually agree with buyer and seller based on that condition at the times, and they both are not related parties. So the fair market value or market value can be different, right? Can be different. Okay, if you go to a oversized market, you know, to bargain something, you know, the two of you probably can get a different price. Yeah, maybe she can get lower. She's good at bargaining, but maybe yes, you know, men's not very good. I believe. Maybe some, yes, but majority, no, right? But many women that's, you know, can have a better price. Yeah. So, but both of them, even though they purchase the same good from the same seller with a different price, you know, that is a market value. But if they purchase, you know, they go back in at the same time, you know, and the same condition together, if you get different price, that is a different story. Of course, it will not happen, right? Because, you know, hey, why she buy with this price? Why? You, of course, will say, hey, I buy on the same price. Yeah. So, but if you can justify the price agreed between seller and the two parties is not related party, yes, should be. But, you know, that's the rule is. But in practice, it's not easy. You know, it's not easy to explain the tax authority sometimes. Yeah. But of course, we require to have some sort of supporting document to prove them. Not just explanation alone is not enough. Okay, but that's still, they said, you know, they put the condition, say where the taxable value of good or service cannot determine, the tax administration may determine them based on arm's length principle. Arm's length principle is a market price or fair value. You know, we can use, this is the same terms. So arm's length principle. So yeah, if they don't believe you, the tax man can say, hey, no, I don't believe you. This product should be $100, not $90 or something like that. Of course, your job is to prove them it is a arm's length or a fair market value or a market price. Okay, that's a taxable base. In general, there's a few conditions you need to take into account. The main condition, the price that the supplier charge to the customers. If you supply as a gift or lower fair market value, you understand what is a fair market value means. Okay, next we talk about input tax, output tax. You know, actually we've been talking about it briefly, previously, but now we need to understand in detail what is the input tax mean and the output tax mean. Okay, is that the good or service purchased for business are called inputs. Good or service purchased for the business are called inputs. And the tax paid on the purchase of good and service called input tax. Yeah, you purchase good, you purchase service for the business, we call input. You know, can be input material, input services. And the tax charge on the purchase, we call input tax. On the opposite side, good or service supplied to the customers are called outputs. The tax charge on the supply of goods or service is called output tax. Yeah, not difficult, right? Whatever we purchase, we call inputs. The tax we charge on our supply to the customer, we call outputs. Yeah. So what is import of article? Import of article for personal use, which means you are not you are not a business entities, yeah, like us, physical person, or sometimes some organization which is not a taxable supply, when they import for personal use, not for the business use, then yeah, not for business use, that's for personal, like us. And you are exempt from custom duty when you import, then you also exempt from VAT as well. And that's kind of transaction called non-taxable supply because there's no VAT applied on the transaction. Okay, input tax we pay on purchase, output tax we charge on supply. Okay, we know that, and now we need to understand what is condition to claim VAT input, or we call VAT credit. This is all input tax, or we call input tax, or in another term we can call we claim as a VAT credit. So we can claim on good or service shall be purchased for a taxable sale or taxable supply of service, or use for to use in producing taxable supply by a taxable person. So all the input tax we pay on our purchase, not all of them can claim as a credit. Not all of them. Sometimes you pay all your purchase for good and service, but not all of them you can claim as a credit. Only the purchase that you purchase for your business, or to produce a taxable supply. Yeah, for a taxable supply, or purchase a business for a taxable supply by a taxable person. So if you purchase something that is not support your business or not for a taxable supply purpose, that's input tax cannot claim as a credit. Yeah. For example, if you are a banks, right? All banks, when you go to purchase good or service from a taxable supply, they all of those suppliers will charge you a 10% VAT on those purchase. Yes, the 10% VAT on the bank purchase is input tax, but the bank is not a taxable person. So the bank cannot claim this input as a credit. So the bank will need to record this input tax as expenses. Yeah, expenses. So yeah, or some purchase by a taxable person, but not directly support the taxable supply activity, also cannot claim as a credit. Yeah, we will learn what a few purchase which is really not considered as a tax credit. We will talk about it, but in principle, they said all the input tax that can actually claim as a VAT credit, only you purchase for the business, first of all, and to support the taxable supply activities by a taxable person. That is the main condition. Yeah, any person who to do a taxable supply, who make a taxable supply. We learn about it. What is a taxable supply? Yeah, all a person selling good and service. Okay, what is a good and service? What is good? What is the definition of good? Huh? Okay, that's all. Okay, yeah, not 100% correct yet. Who is a taxable person? A person who make a taxable supply. A taxable supply is when you do a supply of good and service. Okay, what is a good mean? Go back, what is a good? You define goods. We learned early on. That's my, what is a good? Mm-hmm. Okay. Yeah, you are right, part of it. Okay. Yeah, you are right, but not completely correct. Okay, can someone help? Okay, yeah, not anything. I think you, yeah. All good is all tangible, properties that is not land and monies. Yeah. So if you sell, all tangible thing, this is tangible in phones, water, which is not land and money, this is we call goods. Okay. If you sell this, the person who sell goods, that person make a taxable supply, and then we call him is a taxable person. Okay, how about service? Just review what we have learned. That's the main thing. That is the key points. What is service? No, intangible asset. To me, it is good if you actually sell it, but if you don't sell it, you offer a right to use, then we call royalty. A kind of a service, yes. But what is a service? I think not difficult. Yeah, yeah. Supply of service, a supply of anything for consideration. Don't forget for consideration. It doesn't matter what you do is for considerations. That is not goods, that is not money, that is not land. Okay. Any supply, you can supply anything for considerations. Yeah. Don't forget the word for considerations. It's not good, it's not land, it's not money. We call services. Okay. Now you get, right? If you do all of this, supply all of this two things, you call yourself as a taxable person. Okay, so this is a main condition to claim VAT credit for VAT input we pay on purchase. Okay, so what kinds of document you need to prove to the tax authority that it is your input tax? Okay, first of all, if for import, we have to provide what we call certified custom declarations. Yeah, custom declaration forms, or we call certified custom declaration. When for the import, when you import, you have that custom declaration. Okay, I will give you, show you the example, how it look like custom declaration. Has anyone seen it before? No. Okay, good. No worry. Yeah, you have to cannot just say, hey, I import for my business, because I'm a taxable person. That is not enough. The tax authority say, hey, you have to show me with some evidence. Okay, for import, you show the custom declaration forms. And for the local supply, you have to show we call tax invoice. Okay. Okay, tax invoice. Yeah, you have to show them with a tax invoice. And another word, we can also call VAT, tax. Yeah. Or VAT invoice. Some company they use VAT invoice, some company they use tax invoice. So that term is the same. Okay, and you need to claim in the form prescribed by utility. We have a VAT returns you have to fill in. Okay, how much my input tax, how on purchase? Let's say this month, $10,000. Okay, yeah, something like that. And A nice thing is that a clear and proper documentary evidence shall be produced to certify the GDT that has, the payments. Okay, you need to show sometime if the checks whether you make a payment for the purchase or not. Sometimes you just create a fake invoice, mainly a taxpayer in Cambodia did, in the past, but now it seems reduced a little bit. They make a fake invoice. They want, because they have so many output tax, and then they don't want to pay the output to the governments, and then they create a fake invoice. Okay, you can create a fake invoice because the invoice we produce is, okay, we follow everything, from the tax department instructions, but we ourselves just make a fake purchase invoice. Okay, we just put the supplier name, this and that, maybe you just walk around, you can see, hey, this is a company name, so the VAT numbers and everything, then you can create a fake invoice. So the tax department sometimes they check, okay, you need to prove me with the payment received, bank transfer. So the condition to claim mainly purchase for business by a taxable person. And this is the evidence, custom declaration, invoice, and payment receipt. Okay. Okay, then we have all of this all the above conditions, we purchase for taxable supply, we have document, everything we have a forms, but they said tax credit shall be allowed as input credit for tax paid on. Okay, first of all, taxable supply made during the month or 60 days. This condition, they just under your exam, so the 60-day rule is not applicable. Okay, but you just know because this rule just issued on March 2024. So the for your exam, we only use the term during the month, but this is just for your information. So it means if you get to purchase in August, now August, right? 2024. So you need to claim VAT input in August 2024. You cannot claim in September or in October, or November, December, or you must record the purchase in October VAT returns, which you need to file to the tax authority by 25th of September. You cannot include the August purchase in September VAT returns. That's based on the rule we have. But the 60, which means based on the 60-day rule, what does it mean? Okay, if you purchase in August, maybe because a lot of taxpayer, they busy because we have to do a lot of monthly tax, every month. Then sometimes they forgot to include the August purchase invoice in August VAT return. Sometimes they overlook. And then the tax department just extend for another 30 days, say, okay, now you can include in September VAT return. Okay. So they just provide more flexible for some company that they have a lot of transactions, because most of many company will always complain that monthly tax obligation is tough for them. They cannot include all purchase in the months that invoice issue. So that's why they extend another 60 days. But for exam, this term is 60 days is not applicable for you. But of course, you know that if you you get a job, maybe sometime this year or next year, then you will know, oh, okay, now the time when you can claim as a credit extend from 30 days to 60 days. Okay, so that the time that you need to claim VAT. Okay, somehow you make a mistake. You cannot claim within 30 days or 60 days. You still forgot. Sometimes, supplier send invoice to you, they drop at the receptionist desk. The receptionist doesn't like accountants. And then she threw away somewhere. You don't get it. Yeah, that's happened. It's happened because as accountant and finance, not many people like you. Yeah, it's true. I have a finance manager. She fighting with everyone, try to reduce the cost. And then the other, they want to spend, right? And then they say, why I cannot spend? Why it's so complicated? Why I need to fill this? I need to fill that? Why so many process? Yeah. And you, as accountant, you have followed, accounting policies, when you want to claim this pay expenses, you have to get approval from this person, that person, and you have to fill this form, that form. Sometimes you lazy. Not you, they lazy. Yeah, especially people work in the sales departments, marketing department. Those people, they don't like pepper. Yeah, they don't like pepper. And for them, they always regard their values higher than accounts or admins people. They say, hey, all of those guys love pepper so much, love documentation, and they make no money. They make no less value compared to them because they are the one who actually generate income for the company. If without them, the company will bankrupt. Sometimes they regard themselves higher than you. And then they say, you need to prepare for me, but finance, that's a conflict of interest if you prepare for them, right? They need. So yeah, that's happened. I got a case now. I sent invoice to one of my clients in November 2023. The finance manager just emailed me yesterday. Sorry, I missed your invoice. How many months now? Please issue me with a new invoice. I said, okay, come on. I already declared, to the tax department in the sale last year, but why they just come back to me yesterday, say, okay, can you reissue one invoice to date now so that I can claim VAT? That has happened. Yeah, I don't know what went wrong, but they said, oh, sorry, but I told my finance, no, we cannot do that. That is gonna be a trouble. Okay, yeah, that can happen. And sometimes people said, as an accountant, if you face this issue, sometimes they set up, we call a cutting date. You instruct to all your supplier, if you want me to make a payment for the purchase on times, you have to send me invoice before 25th of every month. Then you can have 5 days or maybe one month to actually work out on the, documentation invoice or prepare a report. Yeah. So that you cannot miss the VAT credit claim. Okay, that's for a first one condition. All import goods during the month, yeah, the same for local supply or import, the same. You have to claim. Of course, new rule, they allow you to actually claim up to 60 days. Yeah. So all the credit allows for taxable business activities. If you purchase for non-business activity, then you cannot claim as a credit. The same, I give you an example as a bank, the same as ComEd. ComEd provide education service. ComEd is a non-taxable person. Yeah, ComEd is a non-taxable person. So all the purchase, all the input tax on ComEd purchase is not a tax credit. So ComEd have to record all of those input as a expense, as an expense. But this is deductible expense for ComEd. Yeah, this is another the time when you can claim as a credit, and we repeat it, all purchase should be support a taxable business. Okay, how we calculate, creditable input tax or VAT payable. Okay, just a simple like this. Let's say you import goods in October 2010. Okay, this example is too old. Okay, it doesn't matter the date, but it's still, the rule and the way that we calculate the method is still the same. So taxable value when you import is 1,000, we just assumes. And of course, you have to pay VAT to the custom, $100, 10% on $1,000 import value. And we assume that you purchase locally, to support your business, another $200. This is your expense. And you pay VAT $20, 10% on 200 is 20. Okay, this is the input tax. Yeah, this one also input tax. This is input tax. Okay, so if this is input tax, assume that you can claim this two purchase, two input tax as a tax credit. So how much your tax credit? Um, 120. Yeah, 100 plus 20. Okay, now you sell the product that you import. Okay, let's say your purchase, your cost of sale is 1,000 and your business expense is another 200. So your total expense, let's say 1,200. But of course, you want to make a profit. You sell your products at 1,500. This is your selling price. Okay, if you sell at 1,500 to the customers, you need to charge 10% VAT on the selling price, which is, this is your output tax, your output. So your output is 150. Okay, now you have input 120, you have output 150. So then you calculate the VAT payable or VAT credit. So you take output 150, you minus credit 120, so you have a positive $30. So this, if you take output minus input, then you get a positive result, which means this is the VAT due, which means you need to pay this 30 to GDT. This means your VAT charge from the customer is higher than your VAT on purchase. Then you have to pay the difference to the GDT. Yeah. Okay, which means you owe the tax administration or the government that you have to pay. So as you can see that the VAT on your purchase, you as a taxable supply or a taxable person, the VAT is not your cost. Yeah. If it is not your cost, because you can claim 120 as a credit to offset with outputs that you charge from the customers. Okay. That's for example, this is a VAT due you need to pay. Example 2. Okay. Let's say you purchase or import the same thing. Okay. The same value, but different months. In November, you import 1,000, you pay hundreds. It's all the same. Your business expense is 200, $20. Again, you have a credit 120, but at this time you can sell only up to 950. You cannot sell all of them. Okay, you charge to the customers. This is 95 is output tax. Okay, Okay, that's all. You know, input still the same, 120, and output is only 95. Okay, now your output 95 minus your input 120. You have a negative of 25. Yeah, you have a negative of 25. At this time, your output is lower than the inputs. And then you get a negative number. If you get a negative number, which means the government owe you, the government owe you. So then we call this as VAT credit carry forward. Say, hey, the government is owe me some money. He owed me $25 in November. So for you, you can carry forward this 25 to offset with your future VATs, liabilities. Okay. Let's say now you have 25 as a credit, carry forward to offset with your, maybe this is in November, but then when you have just assume that the activity in December 2010, sorry, it's still the same, the same like this. But okay, let's assume, you have the same purchase, the same sale. I don't want to, okay. But when you do a December return, you have to account for 25 credit carry forward as well. So what you're supposed to do here, so the 25, which when you fill the VAT return, that the credit carry forward will stay on the top bottoms. So you put 25. Yeah, 25. But in the VAT return, it's negative, which means the government owe us, from the formula that they have. So then you can have, okay, are you going to have a credit or carry forward, or you have a liability? If, huh? How much is it? 50, not 25 anymore. This time you have 50. Yeah, because, your output is still less than the input in December, another 25 plus $25 carry forward. Then now you have $50 carry forward, which means the government owe you $50. Okay, if you keep, your output keep lower and lower every month, maybe what will happen? Okay, now the government owe you so much money now. What will happen? What you can do with that? Huh? So yeah, you can get a refund. No, okay, you can request $50 back from the government. VAT say, hey, now, yeah, please give me back. You get refund back from the government, refund in cash. Yeah, refund in cash. I'm talking about withholding tax. We can get a tax credit, but we cannot get refund, right? Yes. But for VAT, we can get refund. With refund, we can get cash back. The same like, for example, you go to Singapore, maybe you go to Thailand, you buy, you as a tourist, foreign tourist, you buy product in Thailand, they charge you VAT, and when you come to the airport, you can get a refund back. You get cash. Same, Cambodia can get a refund. But for us, tourists, it's not possible to get a refund. Only the business can get refunds. Yeah, because we are not focusing on attracting tourists. Actually, we focus on attracting tourists, but our VAT refund system is not work properly. We don't have a proper system to control. Okay. Okay, this is the way that we calculate, VAT due or VAT liability and VAT credit carry forwards. Yeah. So if, yeah. Do you have any questions? Mhm. Yeah, we do. Yeah, salary, foreign tax credit, we learn about it. But withholding tax is not about foreign tax credit. We learn about withholding tax between sale assess regime and sale assess regime that apply, especially on interest and royalty. Meaning that if we pay interest to a sale assessment taxpayer, then we have to deduct for 15% withholding tax from that interest payments. But of course, the other side is the sale assess regime. He need to declare this interest income in his tax returns. And this income subject to tax on income. Of course, when we deduct him 15%, he entitled to get a credit. Okay, but that I promise you to teach in detail when we study tax on income. Okay, but I just remind you, but that's just remind you that we can also get a credit, but a credit system locally, not a foreign tax credit. Okay, but and then you will learn. For VAT, we can get refunds, but for withholding tax, you cannot get a refund. But we will learn in detail probably next week, I guess, maybe. Not immediately to the credit, but we start to learn about tax on income probably next week. Okay. This output and input. Under this example, we are talking about the entity that can claim all input and all inputs that he purchased, which means he 100% the taxable supply. Yeah. But in some business, for some business, you have a mixed taxable supply, which means you do a taxable supply and non-taxable supply at the same times. Yeah. Yeah. So you run a business, some supply is taxable, some supply is non-taxable. So if in that case, tax VAT law, they have a different rule. Yeah. If you 100% taxable supply, fine, all purchases to support taxable supply, right? This is a main condition, to claim input credit or VAT credit. But in case you do a mixed taxable supply, which means you do a taxable supply, part of it, and some part of it, you do a non-taxable supply. Okay. So what kind of business will do a taxable and non-taxable? The common business. Hospital. Yeah. Hospital is medical service, it's a non-taxable supply, right? But the hospital also provide, we call outpatients and inpatient. For inpatient, everything is a non-taxable supply, but outpatients only the service. But when the customer buy the medicines, it's a taxable supply. So yeah, for running a business, you cannot avoid unless you say, hey, I don't sell. If you it's an outpatient customer come in, okay, I only charge you the service. Okay, you got a doctor prescription. Okay, you can go out and buy from different pharmacy, not from my hospital. Okay, then 100% is a non-taxable supply. But all hospital, not in Cambodia, everywhere, yeah, that's the benefit, right? They can sell, they can make more money for sure. And when you purchase the medicine from the hospital, they always say, hey, my medicine is the best. You cannot find from the pharmacy outside or something like that. And they sell with very high price and very good profit. So yeah. Or sometimes, like CAMET, education service is a non-taxable supply. But, Comet decided to open another restaurant. Yeah. Yeah. If you're selling food, for example, if you're selling, open a restaurant business is a taxable supply. Yeah. Under Cambodian law, they allow Comet to do more business under the same companies. So if you do that, then you have a big taxable supply. And some purchase you can define clearly for taxable and non-taxable, but some purchases cannot. Okay, if Comet open a restaurant business, when he purchased for kinds of like some food or in the ingredient, okay, directly support the restaurant business. Okay, then he can claim 100%. But maybe he purchased office supply, for example, office supply to use for all of the staff work in the restaurant business and also school business. You cannot split it. You cannot split it easily. Then if you cannot clearly split it, okay, we can have what we call the formula. We call ABC formula. Okay, what you need to do is that you take amount of credit allowable for mixed taxable supply and non-taxable supply. Input is calculated based on A multiplied by B over C. Okay, your input credit here, your credit, VAT credit, equal to A multiply B over C. What is A? A, total amount of input for the periods, okay? You have to calculate all your input during the period, during the months. How much is it? B, total value of taxable supply exclusive of VAT made by the taxable person during the period. Okay, let's say you have an input 10,000. Okay, then you have a total taxable value. Let's say the taxable value during that time is 100,000. Okay, what does C mean? C mean total value of taxable and non-taxable supply, exclusive of VAT, made by a taxable person. Let's say you have a non-taxable supply. Of another, let's say 200,000. So then B equal to 300. So which we get from 10,000, 100,000 plus 200,000 non-taxable supplies. Yeah. Okay, then you can calculate how much your VAT credit is. Everyone getting cold? Huh? Okay. For me, it's okay. I have a jacket. And I'm doing a lot of activities, so keep me warm. Okay, can anyone calculate how much the tax credit is? VAT credit is? Okay, you have A, 10K, B, 100, C, 300,000. Where we get it 300 from? We get from, I just assume 100 is a taxable supply and 200 is non-taxable supply. How much is the tax credit? 100 over 300. We get 3,000. Huh? 3. Yeah, probably correct, because this represents around 33%, 1 over 3. Yeah. So you can, as you can see that among your input tax, 10K, you can claim as a credit only 3,333. So the rest is non-credit tax. And then the rest is an expense to your business. Yeah. Okay, let's say, okay, now you have this, you calculate. Can you calculate whether you have VAT credit or VAT liabilities? Do you have VAT credit or VAT liability? Can you calculate that? So now, do you know how much is your output tax is? How much your output tax? Why you don't know? Are you sure? How much is your output tax based on this example? Yeah, you have a taxable sale, which is exclude VAT. So then 10% VAT is on your taxable sale. So how much is it then? 10,000, yeah. And how much your input credit? 333, yeah. 333. So then you calculate, you take your output minus your credit. You take, so your output is, yeah, 10,000, right? It's equal to 100 taxable, because non-taxable is, there's no VAT charge, right? Now we know how much is a taxable sale is, then we know the output. So our output is 10,000. We minus 3,333. So we get positive or negative? Positive. How much is it? Yeah. Really 666. Huh? 666. Okay. 7. Yeah. Okay. Yeah. So if it is positive, this is VTU, which means you pay this to GDT. Yeah. Okay. Yeah. If you're allowed to actually claim, all your input, let's say based on my example, it means there's no, 10,000 minus 10,000, 0. So you don't need to pay anything. But they say, hey, you cannot claim all of it because you do a big taxable supply and you cannot split it clearly. Yeah, there's a formula you use. So you can only claim 3,333 as your credit to offset with your output. So then this is your liability is. Yeah. Okay, that's just a formula applied for a mixed taxable supply, which you cannot clearly split. You use that formula. Okay, this is a general rule. Yeah. Okay, questions? It is clear to you? Can I move on or you need more explanations? Okay, good. So this is a formula. Okay, so yeah, that's a formula, but this also still make taxable supply. But sometimes, they said, oh, the mix is not that big, or the taxable supply compared to total supply is very little, very small, So the tax law say, hey, if you have very little taxable supply compared to non-taxable supply, I say, okay, don't bother about it. Just give all to me. Or you have a taxable supply is okay, a lot compared to non-taxable supply. Okay, then okay, fine. I will allow you to claim 100% input tax. So then they have a, some sort of a threshold for us to compare. Let's say, if you calculate B over C, B is, remember B is, what does B mean? What is B? What is B? Taxable supply. C is total, taxable plus non-taxable. If B over C between 0.05 to 0.95, okay, we use ABC. If in between that, we use ABC formula. Okay. But if B over C is less than 0.05, forget about all your VAT input, auto input. Okay, forget about it. They are not allowed you to claim as a credit. Yeah, which means your taxable supply is so small. They say, okay, shall not allow for input credit. Okay, but if B over C is more than 0.95, okay, all your input tax allow as a credit. You don't need to use ABC formula anymore. So if, let's say, 0.955 or something, or 1, as long as it's more than 95, then you don't need to use ABC formula. Okay, you can claim 100% your input tax. Okay. Okay, this is how we accounted for mixed taxable supply for the VAT credit. But under the VAT law, they also provide us a method of how we can actually use if we do a mixed taxable supply. Okay, in some circumstances, they said the GDT may allow to use an alternative method by separating input tax for taxable and non-taxable supply, if it is possible, or use above formula A multiplied by B over C if it is difficult to separate. Yeah, based on my example, like ComEd, mainly they provide education services, non-taxable supply. But if they open another new restaurants, restaurant business is taxable supply. So they can use straight away ABC, or they can use two different methods. Say separate what you can separate clearly, okay, for the purchase. If the purchase for a taxable supply, okay, you purchase all the ingredient, vegetable, fish, whatever, pork, it's clearly for a restaurant business. So if they charge VAT to you, okay, you can claim that's VAT input 100%. Okay, and then keep it for a side. And then you look at some other supply which you cannot separate. Maybe like I already provided an example, like office supply, office supply for all staff use. Staff work at the restaurant business also can use, and the staff that work in the school business also can use, and you only get one invoice, and you don't know how much the free supply used by the restaurant business and how much for education business. Then you can use ABC for that, only for that purchase. And then you calculate A, B, C formula, and you know how much is the result from the A, B formula, and then you add with the purchase that you can actually identify for a taxable supply business. Yeah. Or if you see that this formula, this rule is not really applicable for your business, the law also say, provide you another opportunity, say, hey, I can create my own formulas. But if you create the formula which is different from ABC or a separate purchase, you need to submit a request to the GDT first. If they approve, then you can use it. Yeah. But nobody do it. Okay, it's waste of times. And if you can do that, probably you can get a PhD degree for VAT. Yeah, because you can create new thing which is applicable for the VAT tax. Yeah. Okay. Questions? Or it is clear enough? Okay. Yeah, maybe not right now, but I will give you some example so that you can practice. I think maybe provide you a better understanding. Okay, if you, the rule also say, if you choose ABC, you have to do we call annual adjustments. So you do on a monthly basis. You need to claim input VAT on monthly basis, from Jan to December. Yeah. Okay, fine, no problems. But you have to do annual adjustment. Yeah. Sometimes, some months you have a high taxable supply. Some months you don't have, you have low taxable supply. The month that you have high, you can claim input more. The months that you have a low taxable supply, you can claim input less or maybe no. Okay, but if you add all taxable supply during the years, probably, your VAT input credit may be higher than you claim during the months. And that's why they require to make an adjustment to be fair with you. Yeah, to be fair with you. Because some months you have a lot of mixed purchase, but your taxable supply so little, less than 0.05. Yeah, you cannot claim $1. Yeah, but of course, some months you have very high, maybe, up to almost 50%, then you can claim up to 50% of the import tax. Yeah. But if you add the two together, percentage maybe higher or lower. It depends. Let's see. So what they said, you're required to do an annual adjustment. Okay. In the first month of the following calendar years, the taxable person who made a calculation input tax by applying the formula A multiplied by B over C, he or she shall calculate the deductible input tax of the previous calendar year by using the above formula based on total annual amount of, okay, A, non-attribute input tax, B, taxable supply. So this is the input tax over the years, and taxable supply of whole years, and C, total supply whole years. Okay, and compare with what you claim from Jan to December. So you need to do this adjustment in the first month of the calendar year, which means you have to, if you claim, by using ABC formula from Jan 2024 to December 2024, and then in Jan 2025, you have to do an adjustment. Okay, whether your input claim is enough, okay, less, or maybe more. Okay, when I say this, maybe I think we have we don't have time. Yeah, maybe Thursday I will give you an example, and then you can see. But adjustment sometimes it's provide you more benefit, sometimes less benefits. Yeah, in practice, it depends on the fluctuation of the taxable supply every month. Okay, annual adjustment. What they're just trying to explain, what you can do is, he said, where the calendar year credit is more than the credit, it's more than the credit, the balance shall be regarded as a credit in the first month of the following year, which means if you claim, based on BC, let's say the more than the return shall be the balance for credit. It means if you claim during the month is less than, like 12 month it all together less than the annual credit claim. I mean, the difference can use as a credit to offset with next year tax returns. Let's say you add up 12 months credit equal to 12 month credit. $100,000. But if you do annual adjustment, and then you will have like 110. Now you see a difference of 10K. Yeah. And this 10K can use as a credit to offset with, or credit carry forward to offset with the future outputs. Yeah, this is you can use as regarded as credit in the first month of the following years. So then you say, hey, now based on my calculation on a monthly basis, I can claim only 100K. But when I use the annual taxable supply and annual supply for taxable and non-taxable together by using the same formula, I can see that my credit is increased. It's 110. So then, based on my monthly return, I claim less. I'm supposed to claim more. So then another 10K will be your credit carry forward. Okay, then you can register or record in the first month of the tax return. But in the opposite way, if your 12-month credit is 100, but when your annual adjustment is, let's say, 90. Yeah, now you have, let's say, a difference of 100. So this will be the VAT payable. You have to pay back to the government because your monthly claim is higher than annual adjustments. So then you have to pay this to GDT. Or, yeah, you have to pay this back to the GDT. Yeah. So this is the rule that they introduce when a taxpayer using ABC formula. In practice, yeah, not many people do an annual adjustment because when they calculate and then see that if you make an adjustment every year, when they see, hey, you need to pay back to the government, right? Say, if I need to pay back, why I have to do adjustment? So it's not the benefit for them. And then they just skip the annual adjustment. Actually, no one do it in practice, So, but remember, the law requires you to do. But why those taxpayers never get caught by the tax auditor? Some tax auditor also doesn't aware of this rule. Yeah, it is true. Many rule that they actually forgot. Yeah, actually forgot. Based on my experience working with them, some rule actually, if they if they do it, they can collect more tax, but they don't. Even I explain to them, say, hey, what you assess is wrong. If the right thing is supposed to be this, and then they don't. They say, oh yeah, I don't want to touch on this because why? I cannot explain to my boss why I forgot about it. Yeah, that is something it's happened. Sometimes they say, if you are an auditor, imagine yourself, maybe you and I, maybe, or him, maybe we fall in the same situation. Say, okay, we do an audit, we issue an assessment, to the taxpayer, and the assessment is wrong, but they actually can collect tax based on a rule which is they didn't know before. And then if they come back to the boss, say, hey boss, sorry, I make a mistake. I assess the taxpayer wrong. But the right thing should be this. What do you expect from the boss? They, oh yes, you are good. That you know that you make a mistake. Do you expect that kind of word? And they just, oh, forget about it. I don't care. Yeah. Okay, this is something happened in practice. Okay. So yeah, again, for a VAT credit for make taxable supply, the formula you can use is ABC on top of the a general rule where you can actually claim 100% on a taxable supply. Okay, we will look at the example, the calculations on Thursday. Then you will understand better how it works. Okay. So this is some purchase by taxable person, but you cannot claim as a credit. Yeah, you purchase, you pay VAT, but the tax man say, no. Even though that purchase is actually support your business. Yeah, because this is no VAT. Okay, but interesting thing is that VAT paid on purchase or import of automobile, unless the taxable person is in the business of dealing in or hiring automobile. They say if you buy a car, basically for your business, and you are not a car dealer, you are not a taxi business or providing a transportation business, all car purchase maybe they maybe you may not you cannot claim VAT inputs. The exception is only if you purchase automobile that have more than 10 seats. Yeah. If you buy a car have more than 10 seats, then you can claim input. But if you buy a car which have seat less than 10 and below, you cannot claim input. If you buy a sedan or minivans, minivan is only 7 seats, some 5, only 4 seats, yeah, 5 seats. Or if you buy Lexus 600, only 7 or 8 seats. So you cannot claim. But if you buy automobile for passenger or a car that have a seat more than 10, maybe you buy a van, minivan, bus, yes, you can claim VAT input. Even though the car is for your business use, but that condition. They said, why they do that? It seemed they said if you purchase all of those, the car has then less than 10 or below seat, is we call a luxury car. So luxury car is expensive. So the intention is, they said the business should not invest in this kind of, of properties. You should save that money to invest in the business activity rather than spending a lot of money to buy a luxury car for the business. Yeah. Actually, this rule is we copy from other, as I said, many countries, they have a proper public transportations, all the stuff. In other countries, some countries, they will not allow you to actually purchase, not just VAT, but they disallow for credit as well, so for deduction as well, because they said the business should not invest in this kind of properties. This is luxury, not appropriate. But those countries, they have very good public transportation, the employee can use public transportation to go everywhere easily and cheap. But for us, not available. And that's why we just have some restriction on that one. Yeah. Okay, so come back on Friday. I will give you the example on how we can, sorry, first day, example of how we calculate mixed taxable supply, and then we move on to this discussion. Okay, so that's all for today. See you again on Thursday. Yeah, have a good day.